Want to learn something new and interesting? Join in. First thing we will understand is income statement. Imagine your wallet is giving you a daily report. It says, "Boss, here's the money you earned and here's the money you spent." That simple report is basically your income statement and also called the profit and loss statement. It tracks income, that is salary, business earnings, rent received and other sources, and expenses, that is food, rent, transport, Netflix, cold coffee, basically everything that pulls money out of your pocket. It's not rocket science, it's just a money in money out tracker. Other thing is a balance sheet. It's something that looks very complicated to people. Let's start and understand it in very simple manner. If the income statement is your wallet's report card, the balance sheet is your financial x-ray. It tells you two things. First, assets, things that put money in your pocket. Second, liabilities, things that take money out of your pocket. Buying a phone on EMI, your balance sheet whispers, "Bro, that's a liability." Buying a rental flat, balance sheet says, "Nice, that's an asset." The magic is in balancing these two, and you are good to go. Now we will understand the cash flow patterns of poor, middle class, and rich people. And it is the most interesting part. Poor people. Poor people earn. Money enters their pocket and instantly runs away to expenses. They pay for food, rent, transport, clothes, and their money ends there. Their entire life happens inside the income statement. Nothing reaches the balance sheet. No assets, no long-term value. Money comes and money goes. The end. Middle class. Middle class life looks stable, but financially it's a trap. Yes, they earn well, but they also collect liabilities like Pokemon cards, car loans, credit card bills, EMIs, personal loans, school loans, and whatnot. Money comes into their income statement and then travels to their balance sheet, but only to the liability side. They are financially busy, but not financially growing. Now comes the part of rich people. Rich people do something very different. They don't just earn, they multiply their money. They create assets like real estate, stocks, bonds, intellectual property, businesses. These assets send money back to their income statement like obedient employees. Yes, they have some liability. Their assets are far greater than their liabilities. Their cash flow first builds assets, then those assets pay for their expenses. In short, rich people buy assets first. Poor people and middle class people buy liabilities first and focus on expenses rather than assets. If you want to grow financially, start tracking your income and expenses. Reduce liabilities you don't need. Build small assets. Even 500 rupees investments count. Slowly shift from a poor or middle class pattern to the rich pattern, where your assets pay for your lifestyle. One small step today is equal to a completely different life tomorrow.